Happy Friday, everyone. Steve Antonioni here, and today I'm going to be telling you about some of my favorite ETFs for this year. Let's just jump right in. If you're new here, let me give you a quick background on myself so you can understand where I'm coming from. I've been investing in ETFs for the past 5 years or so and have grown my money substantially from doing so. Additionally, I have a degree in accounting and I almost became a financial advisor at one point, but I am not a financial advisor, so of course this is not financial advice. But I found the industry to be rather unethical because people could just buy ETFs on their own at a fraction of the price, and that is exactly what we're going to be talking about today. So the format of today's video will be as follows. I'm going to present you with 3 different portfolios that you can build with ETFs, and we'll talk about the ETFs inside of them. And those 3 portfolios are the One and Done, the Tommy Two-Timer, and the Forsworn. Get it? Like Forsworn from Skyrim? I thought it would be nice to try and have a bit of fun with the names. Finance can be so dry, you know? So we'll be walking through how to build these portfolios with different ETFs, and I will be doing my best to make this as accessible as possible to you, regardless of which country you live in. All of the ETFs in this video will be low cost, meaning low fees to own them, and offered by very reputable companies with a very long track record of success. So let's start with the One and Done. Now, this portfolio is by far the most simple, and that's a great thing. Keeping things as simple as possible can save you from overcomplicating things unnecessarily. That's because we can actually build a robust, complete investment portfolio with just one ETF. And the example I will show you today is the Vanguard Total World Stock ETF, which trades under the ticker symbol VT. Is it really possible to just buy one single ETF and that cover all of your investment needs? Can it really be that easy? In my opinion, the answer is a resounding yes. So let's dive into this ETF to see what's actually under the hood here. So this particular ETF strategy is to invest in the stock market of the entire world. And we can see here the exact breakdown of where your money would be going. So 60% of your money would be exposed to the United States, 6% to Japan, and about 4% to the UK. And you can continue going down the list here to see that this is diversifying your money globally while keeping the bulk of it invested in the American stock market. Now, this makes sense as the American stock market has historically been high performing, with many of the most valuable companies that we have ever seen in the world belonging to that market. So now that you know geographically where you would be investing, you might be curious as to how that translates to the exact types of companies that you would be owning inside of this ETF. So you can see that information here, and you'll notice that most of your money is going to be allocated to companies that you're probably familiar with. For example, just over 3% of your money would be allocated to investing in Apple. And then you can see as you go down the list here, you'll see Microsoft, Amazon, and other great companies. So that's how you can tell that there is a heavy American presence here. But as you go further down the list, you'll notice international firms like Taiwan Semiconductor Manufacturing. Now, if you're relatively new to investing, you might be thinking, I never really thought about investing my money internationally. I always just assumed that I would invest my money in the American stock market. Well, in fact, many people do just that. They choose not to invest their money internationally, and that's going to be a decision that you'll ultimately have to make. Speaking from the perspective of a Canadian, I personally choose to invest most of my money into the American stock market, but I also use ETFs to expose myself to international markets as well. The reason that I personally believe in a global investing strategy is because of the research that I've done on the topic. For example, this study here by Vanguard shows how investing globally can reduce the volatility of your portfolio over the long term without sacrificing return. The reason for this is due in parts to the fact that global markets are pretty cyclical. Sometimes the American stock market will be doing really well, but then sometimes the European market will, or the Asian market will, and a lot of the time they're not doing well all at the exact same time. Sometimes they are, but sometimes you'll see others outperform each other. So I personally believe that it's best to kind of spread yourself out so you can ride all the different waves as they happen. However, some people are of the opinion that investing into massive companies like Apple gives them enough international exposure because they sell products or services globally. And I definitely think there is merit to that perspective. So for someone who doesn't want to expose their money internationally, it it is still possible to build a portfolio with just one ETF. And an example of an ETF like that is using VTI instead of VT. So VTI is another Vanguard ETF, and this one just invests your money in the American stock market. And honestly, this particular ETF, if you've looked into ETFs before, you've probably seen this one because it is, I think, by far the most favorite ETF in many investment circles. Many people swear by simply just dollar cost averaging their money into VTI, and that's it, all they do for investing. And I personally think that is an awesome strategy. Now, for my fellow Canadians watching, there's a couple options you have here. You can either purchase VT or VTI on the US exchange, or if you want to keep all your money in Canadian dollars, you can also buy the Canadian listed Vanguard ETF VEQT. Now, VEQT similarly splits your money up across various geographies, but it also invests a good chunk of that money into the Canadian stock market. Having what is known as a home country bias, meaning that you have some of your money invested into your home economy, it's been shown that this can be a good thing, and if you want to learn more about that, there's an excellent article on rationalreminder.ca that I'll leave linked down below. Now, for those of you outside of North America, this strategy can be replicated by, again, either purchasing VT or VTI if it's accessible to you, or similarly purchasing an ETF available in your country that basically tracks the broad American stock market. And then in addition to that, you might want to consider allocating a percentage of your money to invest in your own home economy. So I think these ETFs are great. They allow you to have a one and done portfolio. That's it. That's all you need. Super simple, super easy, and it should perform well over the long term. But what if you wanted to have a bit more flexibility? For example, looking at VT here, what if you wanted to have 80% of your money exposed to the American market as opposed to around 60%? That brings us to the Tommy Two-Timer portfolio. Man, these names are so dumb. I'm sorry, I can't be creative every day, guys. Sometimes the creative juices just aren't running. Anyway, in this case, we can start off with VTI, which you'll recall gives us our exposure to the American stock market, and then we compare it with the total international stock ETF from Vanguard, which trades under the ticker symbol VXUS. And that ticker symbol actually gives us a hint what this ETF will do. It exposes us to the entire international stock market minus the US. So get it? VXUS. So the breakdown for VXUS is as follows. You'll see that 40% goes to Europe, 25% to emerging markets, and so on. And here is the exact country breakdown with Japan, the UK, and China leading the way. So essentially, this ETF allows you to pair it with VTI and then customize the exposures of your portfolio more. Instead of being stuck with the exact rigid allocation of VT, we can pair VTI, VXUS, and choose exactly how much American and how much international exposure we want in our portfolio. Do you want 70% American and 30% international? No problem. Just invest 70% of your money into VTI and 30% into VXUS. A 2 ETF portfolio is still pretty easy to manage. That's still pretty simple, but it does open the door to you kind of fiddling with things a little more than might be necessary for you. But at the end of the day, it's called personal finance. Personal finance. It's all up to you. Now, for Canadians, our Tommy Two-Timer portfolio actually becomes a little bit more involved, twice as involved to be exact. And that's because we can use 4 ETFs to give us our Canadian exposure, our American exposure, our developed international exposure, and our emerging markets exposure. And the ingredients for that portfolio are going to be VCN, VUN, VIU, and VEE. You can whip all of these up however you wish to build whatever portfolio you think works best for you. For viewers outside of North America, your best bet may be to start off with VTI and VXUS if it's accessible to you, and then to pair your home country with that in an ETF in the proportion you want it to. But keep in mind that your country may be already included in VXUS, so make sure to take that into account. So I think that these are some really solid portfolios that we've been building together here. But what if you wanted to get a little bit more advanced, you could say, a little bit more exotic? risk. If you're willing to manage your portfolio a little bit more and have more ingredients in it, there is some evidence to suggest that the ETFs I'm about to show you can potentially increase your returns over the long term. So this next portfolio is the Forsworn, and that's because we're going to have 4 ingredients in this one. We're going to be taking our VTI, our VXUS, and then we're going to be adding 2 a little bit more exotic ingredients to it. And these ingredients are AVUV and AVDV. These ETFs are offered by a firm called Avantis, and the goal of these ETFs is to provide what is known as a factor tilt to your portfolio. What the heck is a factor tilt? Well, explaining that in detail would deserve its whole other separate video, but I'll do my best to summarize it here. Essentially, in theory, there are 5 factors that produce returns in the stock market, and those factors are market beta, size, relative price, profitability, and reinvestment. To put it as simply as possible, factor tilting your portfolio basically allows you to try and target these individual factors to try and increase your return without increasing your risk. So these particular 2 funds here, AVUV and AVDV, seek to help your portfolio do that by adding exposure to small cap value stocks. AVUV covers American small cap value and AVDV covers international. So according to the 5-factor investing theory, by tilting your portfolio to factors like this, by tilting your portfolio towards small cap value stocks, it can potentially allow you to target these 5 factors that produce excess return without taking on excess risk. And according to the model portfolios I've seen by people who are way smarter than me in this realm, it seems like 10% or so is a reasonable allocation to make to ETFs like these. So a Forsworn portfolio might look something like 60% VTI, 20% VXUS, 5% AVUV, and 5% AVDV. Now, even though there might be evidence to suggest that constructing your portfolio in this way can produce excess returns over the long term, I personally do not factor tilt my own portfolio because I like to keep things a little bit more simple. But I wanted to break down a whole bunch of different approaches to building portfolios with ETFs and show you some great ETFs along the way. Ultimately, what you choose to do will be up to you and your own personal financial plan. So what will you go with? Are you a one and done type of person, a Tommy two-timer, or a Forsworn? Honestly, none of those sound like something I would want to call myself. Anyway, hope this was helpful. Thank you so much for watching. See you again soon.